A company is a legal entity formed by individuals or other entities to conduct business activities. It is recognized as a separate legal entity from its owners, providing limited liability protection to its shareholders. Companies are regulated by specific laws and regulations that vary based on the jurisdiction in which they operate. In this explanation, we will delve into the merits, demerits, and benefits of a company in detail. Merits of a company. Limited liability protection. One of the primary advantages of a company is the limited liability protection it offers to its shareholders. Shareholders' personal assets are generally shielded from the company's debts and obligations. In most cases, shareholders' liability is limited to the amount they have invested in the company, protecting their personal wealth from business risks. Separate legal entity. A company is a separate legal entity, distinct from its shareholders. This separation allows the company to enter into contracts, own assets, sue and be sued, and engage in various legal and financial transactions. It provides a level of permanence and continuity to the business, even if there are changes in ownership or management. Access to capital. Companies have an advantage in raising capital compared to other business structures. They can issue shares of stock to raise funds from investors, both through initial public offerings, IPOs, and subsequent stock sales. This ability to attract outside investments can provide companies with significant financial resources to fuel growth, expansion, research and development, and other business activities. Transferability of ownership. The ownership interests in a company, represented by shares of stock, are usually transferable. Shareholders can buy or sell their shares, providing liquidity and flexibility in ownership. This transferability allows for easier entry or exit of shareholders, facilitating changes in ownership and potential capital infusion. Professional management. Companies often benefit from professional management expertise. They can attract skilled professionals and executives who have experience in managing large-scale operations. Professional management can lead to improved decision-making, strategic planning, operational efficiency, and long-term growth. Tax planning opportunities. Companies have certain tax planning opportunities. Depending on the jurisdiction and the company's structure, there may be various tax advantages available. For example, companies can take advantage of deductions, exemptions, and tax credits, optimizing their tax liability. It is crucial to consult with tax professionals to ensure compliance with tax regulations and maximize tax benefits. Brand building and credibility. Companies have the potential to build strong brands and establish credibility in the marketplace. The corporate structure can convey professionalism, stability, and a sense of trustworthiness to customers, suppliers, and investors. This reputation can facilitate customer acquisition, partnerships, and access to financing. Employee incentives. Companies have the flexibility to offer various employee incentives, such as stock options, employee share purchase plans, and employee benefit programs. These incentives can attract and retain talented employees, align their interests with the company's success, and foster a sense of ownership and loyalty. Demerits of a company. Complex formation and compliance. Forming a company involves more complex procedures compared to other business structures. There are legal requirements to incorporate the company, including filing necessary documents, creating bylaws or articles of association, and complying with ongoing reporting and record-keeping obligations. These administrative burdens can be time-consuming and may require professional assistance. Costly and time-consuming. Establishing and maintaining a company can be more expensive and time-consuming than other business structures. Companies often face higher startup costs, including legal fees, registration fees, and ongoing compliance costs. Moreover, companies are subject to additional regulations and reporting obligations, requiring continuous monitoring and periodic financial disclosures. Double taxation. One of the significant disadvantages of a company is the potential for double taxation. Profits earned by the company are subject to corporate income tax. When these profits are distributed to shareholders as dividends, they are subject to personal income tax at the individual shareholder level. This double taxation can reduce the net income available to shareholders and impact overall profitability. Increased regulation and disclosure. Companies are subject to extensive regulations and disclosure requirements, which vary depending on the jurisdiction and size of the company. Compliance with reporting obligations, such as financial statements, annual reports, and disclosure of significant events, can be time-consuming and costly. Failure to comply with these requirements can result in penalties or legal consequences. Lack of privacy. Unlike other business structures, companies often have less privacy. Companies are required to disclose certain information to regulatory authorities and the public, including details about directors, shareholders, financial statements, and significant corporate events. This lack of privacy can be a disadvantage for individuals who value confidentiality and wish to keep their business affairs private. Benefits of a company: longevity and continuity. Companies have the potential for long-term sustainability and continuity. The corporate structure allows for the separation of ownership and management. Changes in shareholders or key personnel do not typically affect the company's existence or operations. This continuity provides stability and can foster long-term relationships with customers, suppliers, and other stakeholders. Growth and expansion. Companies are well suited for growth and expansion. They have the ability to raise substantial capital through equity financing, enabling investments in research and development, market expansion, acquisitions, and new product development. Companies can also leverage their brand reputation and access to resources to explore new markets and business opportunities. Transferability of ownership and exit strategy. Companies offer more straightforward transferability of ownership compared to other business structures. Shareholders can sell their shares to third parties or other shareholders, providing an exit strategy for investors or retiring shareholders. This transferability can be beneficial for succession planning, estate planning, or attracting new investors. Risk mitigation. The limited liability protection offered by a company helps mitigate risks for shareholders. The personal assets of shareholders are generally safeguarded from the company's liabilities, providing a level of financial security. This protection can encourage entrepreneurship, as shareholders are more willing to take business risks knowing that their personal assets are shielded. Enhanced borrowing capacity. Companies often have better access to credit and borrowing options compared to other business structures. Financial institutions are typically more willing to extend credit to companies due to their separate legal entity status, established track record, and financial transparency. This increased borrowing capacity can provide companies with additional working capital for operations, expansion, or investments. Attracting investors. Companies can attract a wide range of investors, including institutional investors, venture capitalists, and angel investors. The corporate structure, with its established legal framework and defined ownership rights, can provide a level of assurance and transparency that appeals to investors. This access to diverse sources of capital can fuel growth, support research and development, and accelerate market penetration. Employee stock ownership. Companies can offer employee stock ownership plans, ESOPs, or employee share purchase plans, ESPPs, as part of their compensation package. These programs allow employees to purchase company shares, providing a sense of ownership and aligning their interests with the company's performance. Employee stock ownership can enhance employee motivation, loyalty, and retention. A company is different from other business structures in several key aspects. Let's explore the differences between a company and other types of businesses. Legal entity. Sole proprietorship. A sole proprietorship is not considered a separate legal entity from its owner. The owner and the business are essentially the same, and the owner is personally liable for all business debts and obligations. Partnership. While a partnership is not a separate legal entity either, it involves two or more individuals coming together to conduct business. The partners are personally liable for partnership debts and obligations. Company. A company is a distinct legal entity from its owners. It is recognized as a separate legal person with rights and liabilities independent of its shareholders. The company can own assets, enter into contracts, and sue or be sued in its own name. Liability. Sole proprietorship. The owner of a sole proprietorship has unlimited personal liability for the business's debts and obligations. Personal assets may be at risk in the event of financial difficulties or legal issues. Partnership. Partners in a general partnership have unlimited personal liability for the partnership's debts and obligations. Limited partners in a limited partnership, LP, or limited liability partnership, LLP, have limited liability protection, shielding their personal assets from certain partnership liabilities. Company. Shareholders in a company generally have limited liability. Their personal assets are typically not at risk beyond their investment in the company. Shareholders' liability is limited to the amount they have invested in the company. Ownership and structure. Sole proprietorship. A sole proprietorship is owned and operated by a single individual who has complete control and decision-making authority. Partnership. A partnership involves two or more individuals who come together to conduct business. Partners share ownership, responsibilities, and decision-making authority based on the terms of the partnership agreement. Company. A company is owned by its shareholders who hold shares of stock. Shareholders elect a board of directors to oversee the company's management and make major decisions on behalf of the shareholders. Transferability of ownership. Sole proprietorship. Ownership in a sole proprietorship cannot be easily transferred. The business typically ceases to exist if the owner retires, becomes incapacitated, or passes away. Partnership. Ownership in a partnership can be transferred based on the terms of the partnership agreement. Transferring ownership usually requires the consent of other partners. Company. Ownership in a company is represented by shares of stock, which can be easily transferred. Shareholders can buy or sell their shares, providing liquidity and facilitating changes in ownership. Management and decision-making. Sole proprietorship. The owner of a sole proprietorship makes all business decisions independently. Partnership. Partners in a partnership jointly participate in decision-making, consulting, and contributing to major business decisions. Company. Companies have a hierarchical management structure. Shareholders elect a board of directors, which appoints executive officers to manage the day-to-day operations. Major decisions are made by the board of directors, and shareholders usually have voting rights based on their share ownership. Regulatory requirements. Sole proprietorship. Sole proprietorships have fewer regulatory requirements compared to partnerships or companies. The owner is generally responsible for compliance with tax regulations and any applicable licensing requirements. Partnership. Partnerships may have additional reporting and compliance obligations, depending on the jurisdiction and type of partnership. Company. Companies are subject to more extensive regulatory requirements, including incorporation, filing annual reports, maintaining corporate records, holding shareholder meetings, and adhering to corporate governance standards. Capital and fundraising. Sole proprietorship. The owner of a sole proprietorship relies on personal savings, loans, or other personal financing methods for capital. Raising significant investments or securing loans can be challenging. Partnership. Partnerships can pool resources from multiple partners, providing more substantial financial capacity than a sole proprietorship. Partners can contribute capital, assets, or intellectual property. Company. Companies have advantages in raising capital. They can issue shares of stock to raise funds from investors, both through initial public offerings, IPOs, and subsequent stock sales. This ability to attract outside investments can provide companies with significant financial resources for growth and expansion. Taxation. Sole proprietorship. Income from a sole proprietorship is reported on the owner's personal income tax return. The business itself is not taxed separately. Partnership. Partnerships are pass-through entities for tax purposes. The partnership itself does not pay income tax. Instead, profits or losses are passed through to the partners, who report their share on their individual tax returns. Company. Companies are separate taxable entities. They must file their own corporate tax returns and pay taxes on the profits earned. Shareholders also pay taxes on any dividends received from the company. These differences in ownership, liability, structure, management, and regulatory requirements make companies distinct from other business structures. Entrepreneurs should carefully consider the specific circumstances, objectives, and long-term plans of their business when deciding which business structure is most suitable. It is recommended to seek legal, financial, and professional advice to navigate the complexities and ensure compliance with applicable laws and regulations. In conclusion, companies offer several merits and benefits, including limited liability protection, access to capital, professional management, brand building, and employee incentives. However, they also have demerits, such as complex formation and compliance, potential double taxation, and increased regulation. Entrepreneurs should carefully evaluate their specific circumstances, objectives, and long-term plans before deciding to establish a company. Seeking legal, financial, and professional advice is crucial to ensure compliance with regulations, maximize benefits, and navigate the complexities associated with company formation and operation. If you like my video, please subscribe to my channel and hit the like button. Thank you.